What's up, everyone? It's Smart Stock Sam coming at you with 3 names that could surprise you in the new year. We've got a biotech with serious upside potential, a beaten-down REIT that's clawing its way back, and a clinical stage runner that's already at new highs. Each one's got risk, but that's where opportunity hides. First up, Arbutus Biopharma, ticker ABUS, healthcare biotech out of the United States trading at $4.81 with a market cap around $925 million. That's small cap territory, which means upside can be explosive if the story catches fire. Float is roughly 66%, so there's room for institutional accumulation without choking liquidity. 10-day average volume sits at 1.44 million shares, and relative volume just over 2.24, meaning attention is rising fast. The relative strength index is at 56.18, showing momentum without being overbought yet. Average true range percentage is 5.21, so expect daily swings of around 5%. Price is in a breakout uptrend state, sitting 4% above the 20-day moving average, 6% above the 50-day, and a massive 26% above the 200-day. It's also just under 3% off the 52-week high and up 67% from the 52-week low. This thing has been climbing steadily, and the trend is your friend here. Now the real question, does the business support the move, or is it pure hype? Revenue year over year dropped 60% to $14.6 million trailing 12 months, which is a red flag for growth. Gross profit is negative $14.4 million, and net income is negative $42.3 million. Margins are deeply negative, gross margin negative 99%, operating margin negative 215%, net margin negative 289%. Translation, every dollar in, they're losing nearly $3 out. Operating cash flow is negative $45 million, CAPEX is minimal at $87,000, and free cash flow is negative $24 million. They're burning cash fast. On the balance sheet, they've got $22.4 million in cash against just $922,000 in debt, giving them roughly 11 months of runway. Dilution over the past year is low at negative 1.85%, so they're not flooding shareholders with new shares yet. Risk exists, but that's why upside can be big if execution improves. If you're serious about making money here, you don't skip the technicals. Latest close was 4.81 on December 31st. Volume was 3 million shares at 2.25 times relative volume in a breakout uptrend. Distance to moving averages shows it's extended, 4% above the 20-day, 6% above the 50-day, 26% above the 200-day. This stock has room to breathe, but it's not wildly overextended yet. Returns paint an interesting picture, up 2.78% over 1 week, 14.25% over 1 month, 4.79% over 3 months, and 50.78% over 6 months. Momentum is strong, but pullback risk is real. ERC is 56, ADR percentage is 5.21, max drawdown was negative 19.78%, currently 2.83% off 52-week high and 67% above 52-week low. Damage has been limited, recovery has been solid. Now let's see what could actually move this next. News, analysts, and who's holding it. News sentiment is neutral with 0 stories in the last 7 days, 0 in the last 30, and just 1 in the last 90. Activity is light. Recent headlines from October and September include Are Medical Stocks Lagging, Arbutus Biopharma this year from Zacks, and Q2 earnings beat from August. Analyst coverage shows a mean price target of $5.73, high target 7.03, with 1 strong buy and 2 buy ratings, 0 sells. That's bullish coverage, and the mean target is nearly 20% above current price. Top institutional holders include Morgan Stanley at 12.71%, Whitefort Capital at 6.94%, and BlackRock at 6.59%. Serious money is present, which adds credibility. Bull case, tight float, rising relative volume, improving momentum, positive analyst sentiment, and a mean price target 20% higher create a setup for fast moves if catalysts hit. Bear case, deeply negative margins, cash burn rate, and low news activity mean execution risk is high and runway is limited. My plan. This is a watch for improved fundamentals or a catalyst that drives volume. If margins stabilize or a partnership announcement lands, I'd revisit with tighter stops. One flag to note: negative net margin. Entry score is 12 out of 100, meaning setup quality is modest. Risk score is 2, so hazard level is low relative to peer group. Exit score is 88, meaning managing this position could be tricky once you're in. This isn't financial advice, it's a dashboard read. Manage your risk, do your own research, and never bet more than you can afford to lose. The upside is, if the setup improves or catalysts hit, moves can be fast. All right, next one. This one's a different beast. Diversified Healthcare Trust, ticker DHC, real estate REIT focused on healthcare facilities, United States based, trading at $4.85 with a market cap of $1.17 billion. That's bigger than ABUS, solidly in small to mid-cap range. Float is 77%, shares outstanding 242 million, 10-day average volume 975,000. Rel vol is 0.71, meaning attention is below normal. This one's flying under the radar. RISI is 47, ADR percentage 3.7, so volatility is moderate. Price is in a weak bounce zone, nearly flat against the 20-day moving average at negative 0.16%, but 4.86% above the 50-day and 31% above the 200-day. It's 5.64% off the 50 two-week high and 138% above the 52-week low. This stock has recovered massively from lows but is consolidating near resistance. Does the business justify another leg up? Revenue year over year grew 4% to $1.54 billion trailing 12 months, showing modest growth. Gross profit is $270 million. Net income negative $352 million. Margins are mixed. Gross margin 17.58% is decent for a REIT, but operating margin is negative 2.52% and net margin is negative 22.9%. Operating cash flow is positive $18.7 million. CAPEX data not available. Free cash flow negative $55 million. They're generating some operational cash, but burning overall. Balance sheet shows $201 million in cash against $2.72 billion in debt. That's a net debt position, which is risky. Cash runway is 44 months, so they have breathing room. Dilution over the past year is low at 0.36%, and dilution risk is medium. Risk exists, but that's why upside can be big if execution improves. Latest close was 4.85 on December 31st. Volume 663,000 at 0.71 relative volume in a weak bounce zone. Distance to moving averages, negative 0.16% from 20-day, 4.86% above 50-day, 31% above 200-day. Returns show negative 3.19% over 1 week, positive 0.41% over 1 month, 10.23% over 3 months, 30.73% over 6 months. It's consolidating after a strong 6-month run. RSI 47, 8R 3.7%, max drawdown negative 26.86%, 5.64% off 52-week high, 138% above 52-week low. The risk-reward setup is tightening. News sentiment is neutral with 0 stories in the last 7 days, 1 in the last 30, 8 in the last 90. Recent headlines include undervalued small caps with insider activity from Simply Wall Street in December, what makes diversified healthcare a strong momentum stock from Zacks in November. Analyst coverage shows mean price target $5.75, high 6.5, with 1 buy and 1 strong sell. Mixed opinions. Top holders include Flat-Footed LLC at 9.7%, BlackRock at 9.51%, Vanguard at 8.08%. Institutional presence is solid. Bull case, recovering price action, Positive revenue growth, decent gross margin, and institutional backing create a foundation for upside if operational metrics improve. Bear case, massive debt load, negative net margin, weak relative volume, and mixed analyst ratings mean downside risk is real if debt service becomes unsustainable. My plan. This is a watch for improving operational cash flow or debt refinancing news. If free cash flow turns positive or a major holder increases position, I'd revisit with conservative sizing, flags, medium dilution risk, net debt on balance sheet, negative net margin. Entry score 17, risk score 6, higher hazard than ABUS. Exit score 83. This isn't financial advice, it's a dashboard read. Manage your risk, do your own research, and never bet more than you can afford to lose. The upside is, if the setup improves or catalysts hit, moves can be fast. Next one, buckle up. SELLAS Life Sciences Group, ticker SLS, healthcare biotech, United States, trading at $3.77 with a market cap of $556 million. Float is nearly 100% at 99.51, meaning almost everything is tradable. Shares outstanding 142 million, 10-day average volume 12 million shares, RelVol 2.54, volume is screaming. RISI is 93.72, which is extremely overbought. HR 9% means daily swings are wild. Price is in a breakout uptrend, 59% above the 20-day, 94% above the 50-day, 118% above the 200-day. It's at the 50 two-week high, 0% off, and 310% above the 52-week low. This is a parabolic move. Can the fundamentals support it? Revenue trailing 12 months is 0. They're pre-revenue. Gross profit 0. Net income negative 26 million. Margins are not available because there's no revenue. Operating cash flow negative 31 million. Capex negative 5.5 million. Free cash flow negative 22 million. They're burning cash with no revenue generation yet. Balance sheet shows 44 million in cash, 600,000 in debt, runway 24 months. Dilution over the past year is 105%, shares more than doubled, which is a massive red flag. Dilution risk is medium, officially, but that 105% number is severe. Latest close 3.77 on December 31st, volume 23 million shares at 2.54 relative volume and breakout uptrend. Distance to moving averages, 59% above 20-day, 984 above 50, 118 above 200. Returns are explosive, 36% over 1 week, 151% over 1 month, 123% over 3 months, 78% over 6 months. This is momentum on steroids. ERS 94, ATER 9%, max drawdown negative 37%, at 52-week high, 310% above low. The risk of a pullback is massive. News sentiment is positive with 1 story in the last 7 days, 3 in the last 30, 4 in the last 90. Recent headlines include assessing SELLAS Life Sciences valuation after positive leukemia data from Simply Wall Street in December, encouraging Phase 2 AML data in December. Analyst coverage shows mean price target 6.83, high 7.5, with 1 strong buy and 2 buy ratings. Analysts are bullish. Top holders include Vanguard at 4.8%, Anson Funds at 4.24%, BlackRock at 3.99%. Institutional presence is light but growing. Bull case, explosive momentum, positive news on leukemia and AML data, bullish analyst ratings with mean target 81% above current price, and rising volume create a setup for continued parabolic moves if clinical data stays positive. Bear case, 105% dilution, zero revenue, negative cash flow, and RSI at 94 mean retracement risk is extreme, and existing shareholders face massive dilution pressure. My plan. This is a trade, not an investment. If I were in, I'd lock profits aggressively and trail stops tight. If you're watching from the sidelines, wait for a pullback to the 50-day moving average before considering entry. One flag, medium dilution risk. But that 105% number tells the real story. Entry score 5, setup quality is weak. Risk score 16, this is high hazard. Exit score 95, managing exits will be brutal. This isn't financial advice, it's a dashboard read. Manage your risk, do your own research, and never bet more than you can afford to lose. The upside is, if the setup improves or catalysts hit, moves can be fast. Drop your ticker in the comments and I'll run it through the dashboard. If this breakdown helped, hit that like button and subscribe for more.